All right, so Yogesh's question directly is, what are the risks rewards of a weekly covered call? Is it better to exit in the event of a loss or better to roll up or down after the contract expires worthless? That really depends on your outlook for the stock. And I know it's very hard, Yogesh, to really know what to be expecting next on the stock itself. That relates in a sense to the apps discussion I had with Maurice today, but he doesn't have weekly options. He just has standard monthlies on those positions. I might use my covered call as an example that I released on that short video today, rolling deep in the money covered calls. But you have a different question. So start off with this. What are the risks for weekly covered calls? The weekly covered calls don't have any more additional risk than a monthly covered call or regular covered call approach. Let's see, that was from last week's webinar, wasn't it? Let's go to the weekly picks of the day. A weekly covered call is shorter term, meaning in general, Yogesh, naturally, you're going to receive a lower premium up front. Okay, so you might have, I'm sorry, I'm sorry, it's my columns are weird here for what we did last week. Let me change up my columns here. I want, I didn't see the net credit in there. Okay, bid-ask spread, net debit. Sorry about that. I just want to make sure I've got everything. So Spire Strike volume. Okay, well, I've got the bid and the ask in there so we can kind of see the position. In any case, these are slightly in the money premiums here. In that case, looking at about a 2.24 premium on this position. Buying stock at 106.51, maybe getting about 860, maybe a little bit more, 870 premium, but that's 224 of time premium for a 2.3% return if assigned for a 6-day trade in this case, not 7-day trade, remember, because the market's closed. Let's go to the options chain. Do I want to do that? No. I'm going to clear this out. We are the 100 strike. Okay, so we're about 6% in the money. Sorry. Here's what I want to do. Let me clear the filters out real quick. And what I'm going to do is go to fundamentals. We're just going to screen against that position, LMND. And what we're going to do is look at all expirations. And I'm going to go about 6% in the money to 10 to try to just isolate this single strike price. I could use the at the money. You know what? That's going to be easier. Let me just use at the money because it's the same across the board. Whether you go in the money, Yogesh, to start, whether you go out of the money, what I want to show you is going to be the same. All right. And I should have sorted by the percent return annualized. Let's flip it. These are just the, oh, I did out of the money. I'm sorry. I should have gone at the money a little bit more. In any case, these are the out of the monies. Why am I doing this? Well, I wanted to show you the comparison. So expecting a premium of, $3 to $4 here, $5 here for 13 days out, a little bit more. What I want to focus on is these two. Okay, wide bid-ask spreads, kind of a pain. December 31st, 13 days out in time. I'm selling a weekly premium here. This is 2 weeks out, of course, but I'm selling a 2-week out premium from 470 to 650. So midpoint, we're probably going to get 560 at best. And that's going to give us, a little bit more than a 5.6% return premium, a 5.6% premium up front, Yogesh, with a 9% return. Twice the amount out in time, right? We're getting 560 a time premium. I go to January 15th, 28 days out. I'm making 910. Am I twice the amount of premium for twice the amount of time? No, that's not the way options work. Meaning that the option that's 6 months out in time is not 6 times the cost of the near term. This is why investors always tell you want to be selling week by week or month by month to maximize the annualized return, assuming all things stay the same, which they won't. The price is going to change, Yogesh. But when I'm buying for protection, that's why I want to be buying maybe 6 months, 8 months out in time. Why? Because here at a time value of 910 for this out of the money option for 30 days roughly, if I go 6 times the amount out in time, I'm not paying $54, I'm paying $23. I get a lower cost per day going further out in time. You get a lower annualized cost buying further out in time. That's just to remind you about the married put positions. But with the covered call, in theory, let's go back to my add remove columns here. And I want to look for annualized, percent if unchanged, annualized midpoint. So since we're using out of the money, I'm using percent if unchanged in that case, instead of the percent if assigned, which would take the appreciation. And as you can see here, the 6 day out, if I'm able to get that, what is it, 370, excuse me, every 6 days, I expect to be around a 219% return. If I do it every 28 days and I'm getting 910, that'd be 121% annualized premium generated against it. Okay, so where does the difference come in? Well, going 28 days out, I'm collecting $9, which means I have a downside protection that's much higher for this 28-day period. The stock can fall 8.5% before I'm technically losing money on the position. And with a shorter term, because naturally we're collecting less premium, because there's less time value, we have a much lower downside protection. The stock can only fall 3% before we're technically losing money on the position. That's the difference. You look to make a higher annualized return selling week by week by week, assuming all things stay the same. You're giving up extra time premium, so for the shorter time frame that you're in the trade, you have a lower premium and a lower downside protection with a covered call. Stock can only fall 3-4% before you're technically below your break-even cost. That's the trade-off. So are you longer term and more concerned about downside protection while still making a good percent return if unchanged that probably meets your goals? You know, if my goal is to make 1 or 2% every 20 days, I'm well within that range on this lemonade stock. Absolutely. Not saying this is the best stock. This is just the first one that came up on the search list. I haven't done any research and analysis on it yet. So that's the only difference. All the obligations are the same. You take a lower premium up front. You have a lower downside protection, but you'll potentially get a higher annualized return. Rolling a weekly option, Yogesh, is the same as rolling a regular one. Meaning that if you start to get close to your break even or your net debit price, stock falls from 106 to 102, you might want to consider rolling down this 110, maybe down to a 105 to start helping hedge some of the loss you're taking on the stock. Let's say it goes to 101, it goes to 100. Well, if I roll down to the 105, I can buy this back more cheaply and then sell that lower call at a lower strike. But now you have to be worried about locking yourself into a loss. I'll show you that in a moment. With the further out, the monthly, my break even is much lower, so I may not consider having to roll down this call in this case unless the stock falls below it. I enter this out of the money position weekly or monthly, and next Tuesday, 3 days from now, the stock gaps up to 115, and I think it's going to go further up. That's when you'd consider rolling up if you think you want to take advantage of more of the upside potential gain, but it's going to cost you. All right, this is now going to cost you $5.20 or $5.50 to buy back because you've got $5 of intrinsic value. So you're taking away this premium. Oh, sorry, folks. You took in $3.70. You got to buy it back for, let's say, $5.20. So you're down only about $1.50. And now maybe you'd look to sell the next week out, 116, 117, if it's available, 120 strike for another $2 or $3. Okay. That depends on your outlook for the stock and if you want to roll it. The webinar we released today, just put this together, 15 minutes, rolling a deep in the money covered call at expiration. This was based from a coaching session I had with Maurice this morning. And in that video, I used my example of the Kraft position, which is a married put for me, but I used it as a covered call. Owned stock of Kraft at $31.50, sold the $33.50 call for 91 cents, and at one point today, the stock was up $35.50, ended today at $34.77. Okay, so where am I? Well, this is what that video talks about. Using the Power Options tools, Yogesh, I'm tracking it in the portfolio. I go to position actions and then position analysis. I see where I stand right now. Look to make 9.5% by leaving it alone and getting assigned today, just taking the profit of 291 and moving on. Now that it's in the money, it's going to cost me 129 to buy it back. These aren't big numbers because it's craft. The position Maurice was looking at was apps, and he had a cost basis of 26 or 28, I think, and had the 40 call. He was looking at about a 15% return, but the stock ended today when I saw it at about 58. So it's cost him $18 for 6 contracts to buy to close those calls and then to roll them up to maybe a 56 or 55 strike going out in time. You'd usually want to roll before it goes too deep in the money. But again, if it happens and it gets away from you, what they do, we see now the opportunities that I could roll to. So let's call this a weekly. Now, it wouldn't be a 9.5%. This is because I had a lower cost basis. But let's say I opened this on Monday and it was about a 1% return. Okay, I'm at 9.5%. Am I gaining this 6 or 7% that the stock had moved up from where I am by rolling the call? No. You're only going to gain another 2%, 1%. The time value that you would get for selling that call right now, that's what you're gaining because you've got to pay back that intrinsic. In this case, it's 129. Earlier today, when the stock was at 35.50, it was at 210 to buy back this call. And then you see the new premium here. Well, if I roll from 18th of December out to the 31st here, why am I not seeing next week, Yogesh? Because it was all rolled for a debit and it didn't increase my potential percent return if assigned for next Thursday on the 24th. That's why it didn't appear. The debits were too high to roll week by week. That's something that you have to consider. For example, on this position, well, let's go back to lemonade position. It was a high premium that you saw for the weekly option. That looked great. It was 370. The stock runs up 5 points beyond your position. Well, you've got to pay that back. Now, hopefully, you're getting another $2 or $3 for the next cycle. But what if you let it run too much? What if I got 91 here and Kraft did end at 36 today, or it went up to 36 and I was looking to roll it? Well, then it's going to cost me $250 to buy to close this call, at least, because I'm at the 33.5 strike. Then I'm only getting a certain amount back. So all these rolls would appear at a debit, which means I have no further downside protection on the position because of the additional cost basis. I might increase my potential return, but does it match my goals? Meaning what? Right now I'm at 9.5% return. If I let it get assigned today in the money. If I roll it up and out, well, I can increase it to 10.8% for January 8th, 21 days away from now. There's an increase of 1.3% in potential return from where I am right now at 9.5 to 10.8 for 21 days match my trading plan? Probably doesn't. Okay, it probably doesn't in that case. That's not my trading goals. So these don't make initial sense to me. I have to roll out further. Now you have to ask yourself, are you doing the right thing by your trading plan by rolling that far out in time? What do I mean? Yogesh, you enter a stock at 10. You sell the at the money 10 strike for a good premium, let's say 50 cents, 5% return. So you get 50 cents for that 10 strike. Reasonable covered call there for a weekly option. Then the stock goes up to 13. It now costs you $3 to buy this back, so increasing your cost basis to $12.50. And if the stock's at 13, okay, you could sell the 13 strike in that case and maybe get another 40 cents or 50 cents or so. Okay, that would still be okay. But if it moved up to 18 and it costs you $8 to buy this back, and you're only getting 50 cents up here for the 18 strike, maybe 70 cents, with your new cost basis on the position, is it worth it to just gain 1 or 2% in that case? I don't know. That's going to have to fall into your trading plan. And that's what this tool helps me to do. Based on where I am right now, to any of these rollout opportunities with the increased potential return, am I able to roll for a credit or a debit? It's okay to roll for a debit if it matches your goals, but in general, you want to look to roll for a credit. But does that increased return from where I am right now match my trading plan for the days I have to roll out to. Sometimes you have to roll out a month or so or more if you're trying to roll for a credit. Now you have to ask yourself if that increased cost basis is worth it, especially if you feel the stock is going to pull back, because now you've got more money in the position, more risk to the downside. Let's take a quick example of a reverse situation, possibly. I'm just going to go on the fly here. You're at 71. Great. So let me enter a covered call for this week. And I don't think this one offers weekly options, but we'll just use it as an example. Bought it this week. Let's say this is a fake trade, so don't try to look up my numbers. I don't think it hit 74.80 this week. Okay, we sold the 75 call. I think this should work. I think it'll still read it. And we got $1.10 for the position. Okay. So now where am I in this position? The stock has dropped 4.3%. It's below the short call strike price. It's going to expire worthless. Would I consider rolling down now? Well, again, I check position actions, position analysis. The math is done for me, Yogesh. Right now, I'm at a loss of 2.9%. Now, I can roll for a profit naturally because it's only going to cost me 5 or 6 cents to buy back this call now that the stock has fallen. And I can turn a loss into a potential winner in this case. So for the next 28 days, remember, this one doesn't offer weeklies. I should have used just Craft to get it at the money prices. But again, rolling up in this case, I can see a potential higher return of 4.2%. There's only a 33.5% chance that the stock's going to be above 75. Is that worth it now to have lowered the downside protection? Staying at the same, rolling in the money now, I only get a return of 0.4%. Well, that's better than a loss of 2.9%, isn't it? No, it's much better. Can't fight that. But it probably doesn't match my trading goals. Neither does a loss of 2.9%. The lock and a loss I was warning you about is, let's say my cost basis was actually 76.50, and I sold that 75 call. That would have to be higher, wouldn't it? I'm sorry about that. Let's say 2. Okay, let me change the numbers here. There it is. So yeah, I can roll up to the 75, and if the stock goes back above 75, I might turn a now 4% loss into a 3% gain. But I don't have that feeling. I think the stock's hopefully going to stay above 70 in this case. So I rolled down to the 70 call. And the best I can do is a loss of 0.7%. That's locking yourself into a loss. That's where I was warning you can happen, Yogesh, with the weekly premiums. I take in a smaller premium of, let's say, 40 or 50 cents on an at-the-money covered call for a low-price stock weekly option. The stock falls 2 points. All right, so I bought the stock at 10, sold the 10 strike call, got 40 cents. It falls to 8. And I say, okay, I want to hedge some of this loss, so I'm going to roll down now. I'm going to buy to close this call for 5 cents, and I'm going to roll down just to the next week to the 8 strike call and get 30 cents. Okay, so what's the problem? You got more premium. You take in 40 cents initially, which puts your cost basis to 9.60. You buy it back for 5 cents because you're rolling out now to the 8, so that puts your cost basis on the stock back to 9.65. Now you sell an 8 call for 30 cents, meaning the most you can get back if you're assigned at 8 is 30 cents a profit. But your cost basis is still 9.65. You've locked yourself into a loss on the trade because the week-by-week premiums are lower just because they have less time value. That's one of the risks you run with managing the weekly covered calls, is that if you have a volatile stock, which likely offered a better premium than 40 cents, I understand. But remember, the stock always, when the stock drops, you're losing more on the stock than you're gaining on the short call. Okay? And you're losing more on the stock than you can gain from rolling down. That's just the way the option premiums work. Okay? I can't, necessarily sell a 10 strike call for $2 every time on a $10 stock. That's a 20% return. That's not common. You can find them using power options, but it's not common. And those stocks are more volatile. I buy it back for 5 cents because the stock fell down to 8. Now I sell an 8 strike call for $2, and hey, I'm looking perfect. Well, if this fell, this 20% from 10 to 8, volatility might increase, but the value of the stock's declining, which means the values of the call are going down as well. Okay. Whenever you have one of those big drops, I had a lot of customers in the past that wanted to try the idea of selling those extraordinarily high premium covered calls weekly or monthly on biotech stocks, right? You look at a $13 stock and you can sell the 12 strike call for $4. You've got almost a 50% downside protection, 48% downside protection, because your cost basis is 8 on a stock trading at 13. Well, that's because this stock has a phase 2 or phase 3 trial coming up. If they fail that trial, the stock drops to $1, $2. Guess what? The $2 strike is not worth $4 now. Now that the event's happened, it's worth 20 cents. So now you've got to make up $6, making 20 cents a month or 5 cents per week. Now this event has happened. It's going to take you a long time to get back to break even. So that's just the subtle differences between the two. Lower premium on a weekly covered call means lower downside protection. Means that when the stock falls and you have to roll, you may be rolling out not to the next week. You may be going 2 to 3 weeks out in time to cover the loss on the stock or to roll potentially to get down to the new cost basis. I only take in a small premium of 40 cents, 50 cents, or $1, and the stock shoots up 6 points. I can't just necessarily roll to the next week. I'm going to be rolling for a debit because I only took in $1, and I'm probably paying $6 to buy back my call now. So yeah, I can sell the higher strike call and have an increased return, but now is it worth it to me to increase the cost basis by that much? Because if the stock starts to pull back, I've now added more cost into the position.